All right. Okay, let's begin. So, just to recap, Sony wanted to buy the flat which Shashank wanted to sell. They agreed upon a price of 1.5 CR, but since Sony did not have the money, or she wanted to ensure that before she buys a flat, whatever news information she has is true. So, what she does is instead she goes into a contract with Shashank, and the contract states that Sony will pay Shashank an amount of 3 lakhs, which will give her the right to buy the underlying, that is the flat, for a price of 1.5 CR on or before 3 months from now. That was the contract. So this is the option that Sony has, which she bought to buy the underlying at a price of 1.5 CR on or before 3 months from now. And for this right, she had to pay Shashank 3 lakhs over and above the flat consideration. All right. Now, during the course of those 3 months, two things can happen. The flat loses value and is worth 1.2 CR. So the flat that was valued at 1.5 CR when Sony went into the contract has now dropped down to 1.2 CR, which means it is at a loss of how much? 30 lakhs. But what is the actual loss that Sony incurs? 3 lakhs. So she did not have to tie up 1.5 CR and incur a loss of 27 lakhs. Sorry, 30 lakhs plus whatever that 3 lakhs. Absolutely correct. Now, the second one is the flat gains value and is worth 1.8 CR now. Okay, now this is the other side wherein the flat has gained value and is valued at 1.5 CR. Now, what can Sony do? Sony can go ahead and buy the flat for 1.5 crores and sell it at 1.8 crores, which is at the market price, and thereby realize a gain of 27 lakhs. Remember, 30 lakhs she got, out of it she had already paid 3 lakhs as a token amount. No, not token, as a premium amount. So her gain is going to be 27 lakhs. Okay, so you get a gain of 27 lakhs on an investment of 1.53 lakhs. But the other option that Sony has is, instead of tying up the capital, buying the flat, and then selling it back again, what Sony decides is she will sell the same right, which is now valued at 30 lakhs. Why is it valued at 30 lakhs? The right which Sony had for 3 lakhs is now valued at 30 lakhs. Can you tell me why is it valued at 30 lakhs? Yes, because the value of the flat has gone up from 1.5 CR to 1.8 CR. Okay, so now if Sony bought the flat at 1.5 CR, what is the minimum gain that she's going to realize? 30 lakhs, Arun. It's 30 lakhs. Forget the premium paid. Forget the premium paid. Okay, so if Sony bought the flat at 1.5 CR and it is now trading at 1.8, isn't she with an inherent value, inherent gain of 30 lakhs? So that 30 lakhs is the minimum value of the contract, options contract. So if Sony has to sell that right to someone else now, she will expect at least 30 lakhs for that right, if not more. No, Shashank cannot oppose. There is no way that Shashank can oppose. See, it's like Shashank does not bother or is worried about. Neither is Sony worried about with whom I am signing the contract. It's a legal contract. 1.8 minus 1.5. The price of the flat is 1.8 CR minus the the original value of the flat, which was 1.5 CR. So how can it be 33 lakhs? It has to be 30 lakhs, right? No. 3 is what you paid Rahul for owning the right. The right's cost is 3 lakhs. Because you paid 3 lakhs doesn't mean that the value should go with plus 3 lakhs. That 3 lakhs value that you paid is going to be within that 30 lakhs minimum value. So I'm saying it also depends on whether it is 30 or more, depending on how much time is there for the contract to be still valid. Okay. So, so one is she can buy the flat, sell it, and realize a gain of 27. The second is she can just go ahead and sell the right itself for a price of 30 lakhs, minimum 30 lakhs. If somebody is willing to buy the right, because that guy might have, let's say Suresh thinks that the flat cost is going to go to 2.1 cr. So he's looking at the jump from 1.8 cr to 2 cr, 2.1 cr. So Sony will sell her right to buy the flat at 1.5 crores to someone else, let's say Sushil, Suresh, and collect the difference. That right provides a 30 lakh advantage to the owner of the right, therefore it is worth at least 30 lakhs, providing a 27 lakh rupees profit. Now 30 lakhs is what Sony will get after selling the right. But in that 30 lakhs, did Sony pay 3 lakhs to own the right? So her net profit is going to be 27 lakhs because 3 lakhs is what she had invested. So on an investment of 3 lakhs, how much did Sony make? No, this it's going to be a totally new contract, Suresh. 27 lakhs. So for an investment of 3 lakhs, Sony ended up making 27 lakhs. That is 9 times. Whereas in the first case, Sony had to put in 1.5 to get 1.8 or have the gain of 27 lakhs. So you see the capital difference. So the first scenario, this scenario is buying the stock and then selling the stock at your asking price, wherein you need the entire capital, you put in the capital and then realize the gain by selling it in the market after the prices have gone up. Whereas in the second case, so this is the stock case or the futures case, whereas in the second case, Sony is only buying the right to buy the underlying, and since the right has gone up in value because the underlying has gone up in value, Sony can just sell the right and pocket the same 27 lakh rupees gain. The second scenario is what is called as a call option. Got the point? So this is what is called as a call option. Any questions on this? All right, let's go to the next slide. Now, this is when Shashank and Sony agreed for a price of 3 lakhs. The contract to be valued at a price of 3 lakhs. Now, what if Shashank also expected the underlying to go up in value because he was also privy to the same information that Sony is, like there's something, a mall or an airport or a metro or something else is coming around. Okay, if that is the case, do you think Shashank would sell the same contract at a price of 3 lakhs? He would always want a higher, right? Because he expects it to go more, the price to move ahead. So the seller will not accept 3 lakhs as a valid payment, and let's say he's asking for a 20 lakh rupees instead, premium of 20 lakhs. What are the resulting considerations? The price of this deal would have changed even before the price of the flat truly changed. So this is just speculation that the flat price is going to change. It hasn't changed, but still the contract is considering the new price. That is what is meant by options not deriving its price only from the price of the underlying. So because the underlying is going to go up is not the only case. It is the expectation that the underlying is going to go up, which will result in the premium to go high. So options are priced based on the underlying as well as what people are expecting the future price of the underlying is going to be. Is that clear? So that's why sometimes you see Nifty's, let's say 10,800 call option is trading at 100 rupees, or sometimes it is trading at 170 rupees. Anticipation, absolutely correct, Chandrasekhar. No, no, sir, this is when before the seller is signing it. It is before the seller is signing it. So Sony says to Shashank that I will pay you 3 lakhs. Shashank says, sorry, I'm not okay with 3 lakhs. I need 20 lakhs if you want to own the right. Now this is the negotiation happening between both of them. Correct, Anand. Negotiation nothing but bid and ask for any options price. Yeah, the property value is whatever is the value. It has not changed. It is the expectation that it will change in the future. Rahul. That's why options are priced based on two conditions. One is the underlying price. The second is what are the people expecting the underlying to do in the future. Right? Any questions on this? This kind of option is nothing but a call option. Call means buying of the underlying. Correct. Parth. Yes, that's what you are going to learn, Anand. But अभी तो एक घंटा भी नहीं हुआ है ऑप्शंस का क्लास चालू होके. No, no, you can buy a call option or you can buy a put option as well, Prasanna. This example of owning the underlying is an example of call option. 3 lakhs is the cost of the contract, Samshuddin. It is over above that 1.5 CR. Please do not mistake, uh, please do not get into that thing of assuming that the 3 lakhs is a token amount. That's a mistake that you're doing. 3 lakhs is over and above the flat price. This is not token amount. Remember that. Yeah, it is the cost of buying the contract. So what are you getting? You are getting the liberty of whether to buy, deciding whether to buy the flat or not for a period of 3 months, right? That liberty is going to cost you 3 lakhs. Correct, Chandrasekhar. Correct, Manish. Yes, Ashish, absolutely correct. Buying the premium comes as call. You're buying the premium with the intention of buying the underlying. Ramesh ji. Amount. Remember that. Yeah, it is the cost of buying the contract. So what are you getting? You are getting the liberty of whether to buy, deciding whether to buy the flat or not for a period of 3 months, right? That liberty is going to cost you 3 lakhs. Correct, Chandrasekhar. Correct, Manish. Yes, Ashish, absolutely correct. Buying the premium comes as call. You're buying the premium with the intention of buying the underlying. Ramesh ji. All right, is everybody fine? Should we go ahead? Perfect. Buying the premium to buy the underlying with the intention to buy the underlying is a call option, Bhavya. Since you're buying the contract by paying premium, that means the premium is going from your pocket with the intention to buy the underlying is what is a call option. Yes, Anand. Okay, no blanket statements like what if, explain again. You have to ask me specific questions, Abrar. Okay. First of all, you stop thinking about what traders do and what traders not do. What we are looking at is the basics, the the understanding of options. In this case, do not even think about a trade position in the stock market. Please, I'll tell you when to think from a trading perspective. Right now, this is an example of the flat. Is there any doubt with this? So, Abrar, if Shashank also had that kind of expectation that something is going to come up near and the flat price is going to go up, which is currently valued at 1.5 cr. So even if he has to get into that 1.5 cr contract, he is not ready for a 3 lakhs premium to give the right to Sony for buying the underlying at a price of 1.5 cr. He's telling Sony that Sony, there is a likelihood that that price can go up. So I'm not going to give you the option to buy the underlying by paying a premium of 3 lakhs. You'll have to pay me a premium of 20 lakhs to own the right to buy the underlying for a price of 1.5 cr. The underlying here is flat for a price of 1.5 cr anytime in the next 3 months. If you want to own this right, I am not willing to accept 3 lakhs. I want minimum 20 lakhs. Are you willing to pay? Yes, we will sign the contract. No, I am not ready to sign the contract. What is the use of the contract? The contract gives you the right to buy or not buy. You can decide within that contract period whether you really want to buy the underlying or no. That's why you have to get into the contract, right? There could be any reason. One is you don't have the money to buy the underlying right now, or you're not sure whether the underlying will move up or no. ओके अबरार, अगर आपके पास फ्लैट है जो आप जानते हो कि वो 1.7 पे जाएगा, प्राइस हो सकता है उसका 1.7, जबकि आज का प्राइस 1.5 है, एंड आप सोचते हो कि अगले 3 महीने में शायद ये 1.7 तक भी जा सकता है, तो क्या आप 1.5 पे बेचोगे या 1.7 पे बेचोगे? व्हाट विल बी योर आस्किंग प्राइस? कॉन्ट्रैक्ट क्यों दिया? किसने दिया? कॉन्ट्रैक्ट साइन हुआ ही नहीं ना, हम लोग नेगोशिएट कर रहे हैं अभी कॉन्ट्रैक्ट के लिए। मेरे सवाल का जवाब दो आप, कि अगर आपके पास एक 1.5 सीआर का फ्लैट है जो करंट मार्केट प्राइस है, और आप एक्सपेक्ट कर रहे हो कि ये 1.7 जाएगा, बट मैं बोलता हूं नहीं यार ये 1.7 नहीं 1.5 ही जाएगा, मैं 3 लाख देता हूँ, चलो प्रीमियम आपको, मेरे को राइट दे दो फ्लैट बाय करने का, अगले 3 महीने में मैं पैसे का जुगाड़ करके आपको बेच दूंगा, आपसे खरीद लूंगा और आपको 1.5 करोड़ दूंगा। बट आपको, आप जानते हो कि अगले 3 महीने में इसका वैल्यू 1. are looking at is the basic. Buying the premium comes as call. You're buying the premium with the intention of buying the underlying. Ramesh ji. All right. Is everybody fine? Should we go ahead? Perfect. Buying the premium to buy the underlying with the intention to buy the underlying is a call option, Bhavya. Since you're buying the contract by paying premium, that means the premium is going from your pocket, with the intention to buy the underlying is what is a call option. Yes, Anand. Okay, no blanket statements like what if, explain again. You have to ask me specific questions, Abrar. Okay. First of all, you stop thinking about what traders do and what traders not do. What we are looking at is the basics, the the understanding of options. In this case, do not even think about a trade position in the stock market. Please, I'll tell you when to think from a trading perspective. Right now, this is an example of the flat. Is there any doubt with this? So, Abrar, if Shashank also had that kind of expectation that something is going to come up near and the flat price is going to go up, which is currently valued at 1.5 CR. So even if he has to get into that 1.5 CR contract, he is not ready for a 3 lakhs premium to give the right to Sony for buying the underlying at a price of 1.5 CR. He's telling Sony that Sony, there is a likelihood that that price can go up. So I'm not going to give you the option to buy the underlying by paying a premium of 3 lakhs. You'll have to pay me a premium of 20 lakhs to own the right to buy the underlying for a price of 1.5 CR. The underlying here is flat for a price of 1.5 CR anytime in the next 3 months. If you want to own this right, I am not willing to accept 3 lakhs. I want minimum 20 lakhs. Are you willing to pay? Yes, we will sign the contract. No, I am not ready to sign the contract. What is the use of the contract? The contract gives you the right to buy or not buy. You can decide within that contract period whether you really want to buy the underlying or no. That's why you have to get into the contract, right? There could be any reason. One is you don't have the money to buy the underlying right now, or you're not sure whether the underlying will move up or no. ओके अबरार, अगर आपके पास फ्लैट है जो आप जानते हो कि वो 1.7 पे जाएगा, प्राइस हो सकता है उसका 1.7, जबकि आज का प्राइस 1.5 है, एंड आप सोचते हो कि अगले 3 महीने में शायद ये 1.7 तक भी जा सकता है, तो क्या आप 1.5 पे बेचोगे या 1.7 पे बेचोगे? व्हाट विल बी योर आस्किंग प्राइस? कॉन्ट्रैक्ट क्यों दिया? किसने दिया? कॉन्ट्रैक्ट साइन हुआ ही नहीं ना, हम लोग नेगोशिएट कर रहे हैं अभी कॉन्ट्रैक्ट के लिए। मेरे सवाल का जवाब दो आप, कि अगर आपके पास एक 1.5 सीआर का फ्लैट है जो करंट मार्केट प्राइस है, और आप एक्सपेक्ट कर रहे हो कि ये 1.7 जाएगा, बट मैं बोलता हूं नहीं यार ये 1.7 नहीं 1.5 ही जाएगा, मैं 3 लाख देता हूँ, चलो प्रीमियम आपको, मेरे को राइट दे दो फ्लैट बाय करने का, अगले 3 महीने में मैं पैसे का जुगाड़ करके आपको बेच दूंगा, आपसे खरीद लूंगा और आपको 1.5 करोड़ दूंगा। बट आप जानते हो कि अगले 3 महीने में इसका वैल्यू 1.7 भी हो सकता है। Yes, you can, depending on whether the two parties agree for that 1.77 CR value. 3 लाख का क्या मतलब? 3 लाख दे के मैं राइट खरीद रहा हूं ना। आज मैंने अगर 3 लाख दिए शशांक को, या सोनी ने 3 लाख दिए शशांक को, तो शशांक वो फ्लैट किसी को भी नहीं बेच सकता। ही हैज टू सेल इट टू सोनी बिकॉज ही इज इन अ कॉन्ट्रैक्ट। इसीलिए कॉन्ट्रैक्ट दिया, और उस कॉन्ट्रैक्ट के लिए का कीमत था 3 लाख रुपए, जो दोनों ने अग्री किया। जब दोनों अग्री करेंगे तभी वो कॉन्ट्रैक्ट ट्रेड होगा ना। एब्सोल्युटली करेक्ट सोनी। अगर मैं 3 लाख नहीं देता, तो जब भी जो भी प्राइस होता उस पर मुझे खरीदना पड़ता ना। अगर 1.7 है तो 1.7, 1.4 है तो 1.4, बट आई थिंक 1.5 शेयर इज अ गुड प्राइस, तो मुझे वो प्राइस को लॉक करना है। ऑलराइट, some benefits of trading options: can get started with very little capital, ability to generate short term income, ability to protect long term wealth, because options are the best hedging tools to protect your portfolios, versatility to fit your trading and investing style, trade options on stocks, futures, and forex, and variety of strategies that you can use. These are some of the benefits of trading options. Yes, you can. The same thing will run on commodity, forex, options on futures, options on stocks, options on indices, anything. There is no separate class on how to trade options on commodities, how to trade options on forex. There are examples, Anand. That's it. Otherwise, everything else will be hedging will is primarily going to be covered in proactive investor. But I'll definitely explain basics of hedging. Now, 4 reasons to trade options: leverage, protection, diversification, and various strategies. These are primarily the 4 reasons because of which you will trade options, and they provide a distinct advantage to us. Leverage: controlling a large asset with a small amount of capital. Can you give me an example? The one that we discussed. Absolutely correct, Anand. Both Anands. So you are controlling a 1.5 CR flat with just a premium of 3 lakhs. So in both the cases, if you bought the flat and sold the flat in the open market, or if you only bought the right and sold the right, isn't in both the cases you are still going to make the same gain? That is 27 lakhs. Why no, Arun? You buy the flat at 1.5, sell it in the open market at 1.8, and you realize a gain of 30 lakhs, but in that 30 lakhs you had paid 3 lakh premium. And the second option was, instead of buying flat and then selling it in the open market, what you do is you sell the contract only to someone else, which is right now valued at a price of 30 lakhs. So 30 lakhs minus 3 lakhs that you paid as a premium is what is going to be your net gain, which again in both the cases is the same, 27 lakhs. So isn't it smarter to make the same gain with lesser capital? Perfect. So options trading not only provides regular leverage, but dynamic leverage when building the position properly. So we'll speak about dynamic leverage when we cover delta. Powerful money making tool when used properly. If you use this properly, this is a very, very powerful money making tool. Second is protection. Protection of a script or a whole portfolio through defining a fixed exit price. Now, hedging is primarily done using put options. What are put options? We'll cover later on. But hedging is primarily done with put options. What do put options give you? Put options give you a guaranteed exit price. A guaranteed exit price. It works as an insurance where a worst case situation is predefined. The third is diversification. You can trade directional using options. You can trade non-directional using options. Like currently, the markets are in a non-directional state on a higher time frame, and probably in a lower time frame they are on a downtrend. But on a higher time frame, they are in a non-directional mode and sideways. Yeah, non-directional means sideways. And sideways, there are different strategies that you can employ using options. You know, it's very difficult to trade futures or stocks in a sideways range, but you can trade options in a sideways condition. Use of different strategies to balance the Greeks of the portfolio and manage exposure to script movement, volatility changing, time passing, and changes in interest rates. So when you're trading options, right? When you're trading options, your options prices are affected by certain conditions or certain parameters. The most important parameters are the underlying movement, volatility changing, time passing, and changes in the interest rates. Greeks means they are parameters used to assess the options risk. We'll cover that starting from tomorrow. All right, that's diversification. Fourth is various strategies. Options trading is the most versatile method to speculate in the markets. Advanced strategies like Vega bombs or breakout for freeze are taught in the XLT programs. So these are advanced strategies. There are more advanced non-directional strategies available in the market, which you can in XLT is more advanced non-directional strategy like iron butterfly and horizontals and diagonals and double diagonals, and then directional strategies, another set of non-directional strategies. Everything will be taught in the XLTs. So depending on the market conditions, many different strategies can be used. Any questions? Yes, Rahul. Writing is selling, Dhirendraji. Option writing is nothing but option selling. You can sell an option to open a position, or you can buy an option to open a position. Anything can be done. Yes, XLT program means the options XLT program. Correct. Yeah, it's all online. Correct. You have been attending, right? Your option XLT is 2 days in a week. Okay, no problem. All right, what are options? An option is simply a contract that gives you the right to buy or sell a particular script at a particular price. Okay, now let me give you another example of a call option, which is very common with all of us. Do we buy medical insurance or car insurance or home insurance? Now, what does that mean? Okay, you you tell the insurance guy that I want to insure myself to cover up all the medical expenses in cases of emergency. So you decide how much insurance you want. Let's say I want a 10 lakh medical insurance. So 10 lakh is the price which we are agreeing upon. The contract value is going to be 10 lakhs, and the period is going to be, let's say, 1 year from now. So for a period of 1 year and for amount under consideration of 10 lakhs, I am the option buyer who will pay a certain premium to the option seller, which is the insurance company, to own this right to claim the options, to claim the medical insurance in cases of emergency. Got it? So let's say you pay 10,000 rupees to have a cover of 10 lakhs for a period of 1 year from now. So this is nothing but a call option. This gives you a right to call the call for the insurance in cases of need. No, no, not call means buying the underlying, Rahul. Call option always relates with buying of the underlying. put option always relates to selling of the underlying. So when you buy a call option, you own the right to buy the underlying, and when you buy a put option, you own the right to sell the underlying. All right? No, Arun, I am not selling Mediclaim. I am buying Mediclaim as an option buyer, and the insurance company is the one who is selling me the medical insurance. So he's the option seller and I am the option buyer. And when you purchase a medical insurance, it is nothing but a call option. There is no real life example for put, by the way. That's why I can't give you an analogy. The only thing that I can do for a put option is by comparing it with a stock. Okay, so let me just give you an example of a stock for both call and put option. Let's say now all of your favorite stocks like an Ashok Leyland or a Tata Motors. Let's say people who are interested in buying Tata Motors. No, Shrikant, car insurance is still call option. क्यों अपना दिमाग लगा रहे हो? मुझे एक्सप्लेन तो करने दो पुट ऑप्शन क्या है. जितना ज्यादा सोचोगे और दिमाग लगाओगे उतना कंफ्यूज हो जाओगे. डिड आई आस्क यू फॉर ए पुट एग्जांपल? जो सब लोग अपने बिंदास लेने चालू हो गए. सर पुट मतलब मेडिकल इंश्योरेंस है. इंश्योरेंस कंपनी पुट ऑप्शन है. कॉल कॉल को ऑपोजिट पुट नहीं है अरुण. Absolutely correct, Funny. Any insurance that you buy is nothing but a call option. Yeah, Renuka, sorry. All right. So let me give you an example with the stock. Let's say you want to buy Tata Motors at a price of let's say 150 rupees. But right now you do not have the money to buy whatever amount of Tata Motors you wanted to buy. So since you don't have the money, what you can simply do is you can go and buy a 150 price ka call option. Because what does a 150 call option give you? 150 call option gives you the right to buy fixed number of shares at a price of 150 on or before the expiry. That is whatever the validity period is. And for owning this right, you will have to pay the premium. So on or before the expiry date, you are going to go ahead and exercise this right to buy the underlying stock. Is that clear? That is what is a call option with respect to a stock market. Now let's say you own ITC, which is trading in a supply zone, and you fear that ITC might fall from that supply zone. So you want to protect your investment, or you want it may fall or it may not fall because the trend is strong enough. Okay, but if it falls, your valuation is going to reduce, isn't it? If ITC falls, then you're going to lose all your gains or whatever gains you had made, depending on how much the fall is. Now, to protect from this, in case it falls, you want to exit. In case it doesn't fall, you want to hold it. How do you do this? You simply buy a put option. Why? Because put options give you the right to sell the underlying at a specific price on or before a set date. Just like a call option gives you the right to buy the underlying at a specific price on or before the set date, put option gives you the right to sell the underlying at a specific price on or before a specific date. Now is that clear? So ITC is trading at a supply zone of 290 and you expect it, if you think it's going to fall from 290 to 230, thereby erasing gains of 60 rupees. So what you simply do is you simply go and buy either a 290 or 300 put option. What does the 290 put option give you? The 290 put option gives you the right to sell the underlying at a price of 290 on or before the contract expiry date. Are we clear? I just said 290 or 300, either of them. I do not hedge futures with options, Dhirendra ji. सुरेश जी 290 एक्सपायरी तो दूर है यार. हम लोग 290 चूज कर रहे हैं बिकॉज सप्लाई जोन 290 से चालू होता है, वहां से कहीं भी गिर सकता है, इसलिए हम लोग ने 290 चूज किया. Is there any other question, Mr. Suresh? 290. 290 is the present price. Okay. An option is, all right, I'm just waiting for Mr. Suresh to complete his questions. I am giving you an example of put option. Suresh, okay. So a stock is trading at 290 rupees, which is a supply zone. Do you know what is a supply zone? What happens at a supply zone? You sell because you expect the underlying to fall, right? The stock to fall at supply zone, isn't it? So if let's say you owned 5,000 shares of ITC which you bought at 100 rupees. Let's assume this is the example. Now Mr. Suresh, please pay attention. Because you ask a question and I think you disappear when you're not answering my questions. Okay, pay attention. Let's say you own. Alright, I don't want anybody to type or write what I am going to say. You're not going to get marks for this. So you just pay attention to what I am trying to tell you and just answer the questions when I ask you. Till then, nobody types. Let's say you own 5,000 shares at 100 rupees of ITC. What is the valuation of this? The entry valuation. Suraj, how 100? 5,000 shares you own at a price of 100 rupees. So total valuation cannot be 100, right? 100 is the price per share. It's going to be 100 into 500, that is 5 lakhs, isn't it? So that's your entry valuation. Now the stock is moved to 300 rupees. So what is the current valuation now? 15 lakhs. So you are sitting on a gain of 10 lakhs. Okay. Now you are sitting on a gain of 10 lakhs. And what has happened is 300 is where the supply area is for ITC. What happens at supply, Mr. Suresh? People sell because you expect the underlying to go down in value, right? The stock might drop down, let's say to 230, which is the next demand zone. Do you agree with this? Are you okay with this? Now, as a holder of this and as a educated trader, you know that the stock can fall up to 230. The stock can fall up to 230. What is that you are going to do? What are the options that you have in front of you? It's not going to be a loss. Your profits are going to reduce, right? Let's say you held on to those ITC shares. You held on to those ITC shares, 5,000, and the stock dropped from, let's say, 300 to 200. That is where the next demand is. Your valuation was 15 lakhs. Now, has it reduced again by 5 lakhs? Your profits, have they reduced by 5 lakhs? Correct? Now, you can either sell off everything at 300 and buy it back at 200. But can this surely happen? Correct. What can happen? It can break the supply and go up as well and give a new high. Let's say move to 350. Perfect. Now, since there is a risk to your stock holding at a price of 300, why? Because there is a supply zone. So there is a chance that it might drop down. There is a chance that it might take off that supply. But what if it drops down? So these are the risks associated to your holdings. So to mitigate that risk, what you do is you simply go and buy a right to sell the stock at 300. Buying a right to sell at 300, does it really mean that you have to sell? It provides you an option whether you want to buy or no, sell or no, correct? You may choose to sell, you may choose not to sell, isn't it? So tomorrow, let's say the stock gaps down from 300, it opens at 270, which means the supply has worked and now the stock is likely to go all the way to 200. Yeah. So what? But you own a right to sell the stock at a price of 300, isn't it? For which you have the premium. Now you go and exercise your right. You tell the seller of the put option, whoever has sold you the put option, you tell him, boss, take the shares and give me my money at a valuation of 300 into 5,000. So you are still going to make 300 into 5,000, and the cost of this is going to be the premium that you paid for the put option. That is what is the put option. You are willing to put the shares that you have into the hands of someone else. And who is someone else? The guy who sold you the put option. Amit, go ahead. अरे धीरेन्द्र जी, अभी पहले कंसेप्ट तो समझो ना. हाउ मेनी पुट्स? हम निटिग्रिटीज में थोड़ी जा रहे हैं अभी. पहला ही दिन है आज और 4 दिन बाकी है. 4.5 अपने 5 दिन बाकी है. Don't worry, everything will be covered. Just that it will be covered at the right time, not when you ask. Yes, Amit, in this scenario, yes, you need to have those shares in your demat. But even if you don't have those shares in your demat, you can instead trade the options by buying a put. You can still do that. Correct. It is a right to sell at 300 because you own a put option. Pudupet. Yeah, but exercising the right, you need to have it. So if you don't have underlying, and then you won't exercise, you will trade. You will offset. You'll trade off the contracts. That's it. We'll come to that. Okay. How do we exercise the right? अरे पहले हम लोग को आम का पेड़ तो उगाने दो, बाद में आम खा लेंगे यार. दुबे जी, just to quickly answer your question, we actually do not exercise anyways. Okay, just this is understand this. Here confusion buying or call. What is the confusion, Ramesh ji? हम लोग तो put buy कर रहे हैं because we want to own the right to sell our underlying, right? Correct, Shamsuddin. Because see, you know what happens? Whatever you lose in the underlying, so the underlying has moved from 300 to 270. You have a loss of 30 rupees here, Shamsuddin, because the underlying has moved down to 270. Correct. But similarly, since you own the put option, your put option will also be trading at a minimum value of 30 rupees. So whatever you lose in the call option, in the underlying, you make it in the put option. So the put gives you the guaranteed exit price at 300. Then you buy a put option, Surajji. No, I did not have a call at 100. What I had at 100 was the underlying. That is what I had bought. You could have at that point in time at 100, you might have wanted to buy a call option. That is fine. Who told you, Pudupet, that when we buy put, we buy a put price below the current market price? एक एक नॉविसेस बाहर आ रहे हैं अभी. मैंने बताया कि अभी तक कि पुट प्राइस करंट मार्केट प्राइस के बिलो बाय करना है करके. मैंने स्ट्राइक प्राइस का भी बात किया है क्या अभी? This is what happens when you have some knowledge of options and you come to learn options. You start comparing your knowledge and what I am teaching you. So the first thing that you have to do is completely erase your mind with whatever knowledge of options you have. This is true for the freshers. If this is the first class that you're attending, I will not entertain any of these questions. In the beginning itself, I told you, do not ask me questions based on your half-baked knowledge. It is going to slow down the class. You have to ask only what I am teaching. Now, I did not talk about strike price. I did not talk about anything else, but the questions are coming on that. No, Sushila, it's not a retakers class. It's a fresh class. This batch still has 30 waiting students, fresh and retakers both. Right? At put 300, had the price gone to 350, even then I would have only 15 lakhs, not 70. Yes, Samshuddin. Because whatever you gained in your underlying, you lost in the put option. Yes, put will be in the loss, Rameshji. But why are you bothered? You also own the underlying, right? In a normal scenario. But let's say if you're a trader who is trading options only for the premium gains, then you would incur a loss there, and you would get out of the trade for a loss if it goes past the supply zone. Simple. Like a stock trade, right? If it passes the supply zone, distal line, stop loss line hit किया, हम लोग loss में आ गए, isn't it? Yes, stop loss is there in everything that you trade in the financial markets. No stop loss, no trade. All right, are we clear with this? An option is simply a contract that gives you the right to either buy the underlying or sell the underlying. Now, the underlying could be a script, a future, a ETF, a index, a forex contract, anything. Okay. So an option is simply a contract that gives you the right to buy or sell the underlying at a particular price on or before a particular date. So every options contract will have a fixed period, and every contract will be at a fixed price. And for this combination, there'll always be a premium associated. Who decides the premium? The buyer and the seller decide the premium. They are the one who negotiate. Options are known as derivatives since they derive their price from the price of the underlying. Okay. Now, we saw some examples before the flat example. Does really option pricing depend on the underlying only? What is the other factor? Expectation. People's expectation. What are they expecting the underlying is going to do? Now let me ask you a simple question here to understand this. Nifty is currently trading at 10645. What is your expectation for Nifty? Is it 10,800 or 10,500? Okay, Bhavya says 10,500. Okay, it's divided, right? Which is how the market is. It's divided between in bulls and bears. So somebody is thinking that the markets are going to go down. Somebody think the markets are going to first go up. Okay, it's your perception, isn't that? Isn't it? So those who are thinking the market is going to go down, what are they going to do? They're going to buy a put option, right? Because markets are going down. And those who think markets are going to go up, what are they going to do? They're going to go ahead and buy the call option. Why? Because they think it is going to move up. So this expectation is also what is going to price the options along with the underlying. Okay, a stock that is trading at 300 rupees will have a different option price because it is trading at 300 rupees versus a stock that is trading at 2000 rupees because the underlying is trading at a price of 2000 rupees. All right. Trading options without proper education is risky because their value can be affected by things other than just the price of the script. One of the other things that we know is the people's expectation for the underlying price. What is going to be the underlying price in the future? Options are used for directional trading. In an uptrend, get aggressively or neutrally bullish at demand. What is the confusion, Ramesh ji? That'll get clear. Don't worry. Okay. Now, short-term income. Options can be used for short-term income, which is directional trading. In an uptrend, get aggressively or neutrally bullish at demand zone. In a downtrend, get aggressively or neutrally bearish at supply zone. Non-directional trading, profit from lack of movement as the script stays within a range, like what we see in Nifty. Nifty is ranging between right now 10,900 and 10,600. So that is the range. You can, instead of trading the underlying stocks or futures, you can trade options instead as a non-directional strategy. Long-term wealth options can also be used for long-term wealth, which is for protecting script options, script positions. That is, you hold portfolio and you want to protect the portfolio in case of bear markets or downward markets. Entering script positions at discounted values, collecting extra income from a script position, that is renting the script, and mimicking the script position only cheaper. This is covered more in detail in proactive investor program. I guess those who have bought solutions will have proactive investor as a part of their